Yeah, I think it's just the process of something that's very complicated, a lot of people involved, very paperwork intensive, and as the process evolves, the amount of work expands a little bit. There's really nothing incrementally new, other than it seems like it'll take a little bit longer. Both sides working very hard, very good faith, and making a lot of progress. And it isn't really, you can see from our results for the quarter, it really isn't having an impact on how we run the business, the number of customers we serve. We grew both loans and deposits and managed to have record EPS and a very profitable quarter with a balance sheet that's a little bit less than $2 trillion, which is big enough to serve all of the customers who we seek to serve. So we're working very hard on it. The entire, oh, go ahead.
But in terms of whether or not investors have confidence that management really knows exactly what it is the Fed needs you to do, clearly the share price reacted negatively today when you pushed it back, and it's not the first time you've had to do that. Could that happen again?
It's this is a first of its kind type of exercise for us and for them. It's a large deal of work. There's a lot of people on their side and on our side that are involved. So there is no playbook. They don't have a strict script to work by, and neither do we, but both parties are working hard and want the same things. There isn't major disagreement about any of the end game that we're shooting for, and so it's evolved somewhat. If we could be more precise, we certainly would, but everyone is working as hard and as smart as they can to deliver against the requirements that are laid out in the consent order.
John, forgive me, one more question on this topic. I mean, clearly
Sure.
you and Tim Sloan say it's not impacting the way you do business, but for the last 6 quarters, you've seen your revenues decline on a year-on-year basis at a time when your peers and your rivals have seen it grow. So what's causing that difference in performance if it's not the Fed asset cap?
Sure. Well, there are a handful of things. First of all, we have different business mix than many of our peers, and the couple of banks that have also reported thus far on the fourth quarter tend to be more markets-driven, a little bit more cyclical in that way. Other banks have a different emphasis, for example, in the credit card business, which is less of a business for us. We've been operating at a high level, generating a very high return on equity among GSIBs for sure throughout this entire period. Mortgage has gotten smaller. We're a big mortgage player, so we probably have a higher index on that than most folks. And our balance sheet has shrunk a little bit as interest rates have increased. Deposits have left the system, which has caused our deposit growth rate to turn from high single digits in some categories to negative. People are moving money into money market mutual funds and the like. Deposit costs have gotten a little bit more expensive. So we're looking at the whole picture of total revenue generation, the cost to deliver it. We hit our expense target for the year that we laid out for investors. And then what that generates as a return on equity for our shareholders, which for the quarter was in the range of 13%, which is at the high end of the range for GSIBs. That's during a time when we're completely reinventing the company and bearing a lot of extra cost in order to do that properly. So we're on track toward a delivery of a 15% ROE, we think in 2020, based on how we've laid things out for investors. Again, it's revenue, it's expense, and it's the capital denominator in that calculation. And in spite of all that we have going on and the hard work that we're doing, while we're doing it, that is a high level of return.
So I always look, John, at your mortgage business, and I know that Q4 is seasonally a weak period, but mortgage originations down 28% from this time last year. Talk about what you're seeing as far as weakness in the U.S. housing market.
Yep. So, sure, I don't know if it's weakness in the market, but you'll recall that going into for the first 2/3 of the fourth quarter, the long rates had moved up appreciably, and so mortgage origination expectations had slowed down because affordability and refinanceability were a little bit out of the money. Rates came rallying, crashing down into the end of the year in a larger risk-it-off trade, and so in the first quarter, you actually see applications up meaningfully over just a quarter ago. But first of all, it's the winter, and so there's less home buying going on in the winter versus the warmer months. And secondly, rates were higher, which had slowed things down. We'll see what happens and how long rates remain where they are, but we're well under 3% on the 10-year after being in the 3.20 range in the fourth quarter. And at the margin, that makes a difference as well.